Welcome to the Bloomfield Township Retired Employees Healthcare Benefits Trust meeting, Tuesday, January 31st, 7:30 a.m. Looks like all members are in attendance. We'll open for public comment. Hearing none, we'll close that and move on to approve the meeting minutes of October 26, 2022. Are there any adjustments or motion?
No adjustments. Make a motion to approve the minutes.
Motion by Treasurer Keeps.
Second.
Second by Trustee Shostak. Meeting minutes are approved. Welcome, and we'll turn it over to you guys for fourth quarter and 2022 financial investment review.
All right, so we have the full book that we passed out, and then supplemental charts and slides. There's a consistent theme here. We only bring out charts and graphs when the numbers are bad. When the numbers are good, the pretty charts seem to cease. But put together a couple slides, just kind of help from a contextual standpoint and visual standpoint, and talk about calendar year 22. Difficult year for investors, not only from an equity standpoint, but also from a fixed income standpoint. And you can see that laid out. So what we have on the dot plot chart in the graphics is calendar year returns for the S&P 500 from 1976 through 22. That would be the y-axis, the vertical axis, and the x-axis going from left to right is the Bloomberg U.S. aggregate bond. And much to the chagrin of my high school, would that be geometry or algebra? The only reason I know which is the x and the y-axis is because it's already labeled in the title. But what you see laid out here is really the magnitude and how calendar year 22 is an outlier, because you'll see that green dot in the bottom left-hand corner. And it wasn't an outlier from a return on the S&P 500 standpoint, because even though it was down 18% for the year, calendar year 2002, calendar year 2008 were much worse. I think back to 2008, the S&P was down 37% that year. But it was an outlier in terms of negative returns for the U.S. aggregate bond, because that high-quality U.S. investment-grade fixed income index was down 13%. It is the worst return for fixed income for the calendar year in recent history. And it is actually the worst return for fixed income in the history of, the modern capital markets. And I'm talking, 1920s to present. Page 2, found this really interesting. So a couple different charts here. What we're looking at from 1928 to present, so the entire history of the S&P 500 is daily price volatility. So the green bar chart at the top measures trading days that are up 1% or higher. Think of these as the days where it feels really good to be an investor. The historical average is 12.5%. Calendar year 2022, we were down 18% for the year. 23.5% of the trading days last year were up more than 1%. So we had 2x the historical average of great days. The highest was 1938 at 29.6. Blue bar chart in the middle is measuring trading days that are negative 1% or worse. Think of these as the days you wish you were in cash. Historical average 11.7%. Calendar year 22, 25.1. So we had 2x the bad days, we had 2x the good days. Bottom chart was what was surprising to me. So the bottom line chart is measuring the percentage of annual trading days that are in negative territory. So just something below zero. Any type of negative return. The long-term average is 46%. So on average, 54% of the days are positive, 46% are negative. Calendar year 22 was 57% of the days were in negative territory, 43% were in positive. What was really surprising to me is the skew of the line. It never gets above 60%, never gets below 38, 39%. So even in a great year, it wasn't like 80% of the days were positive, or it wasn't in a terrible year like 70, 80% of the days were negative. It seems to always kind of fall between a maybe 60-40, maybe 63-37 ratio, but it's never this big swing where 80-90% of the days are in positive territory or 80 or 90% of the days are in negative territory. So the moral of the story as you look at this is volatility happens. Negative days happen a lot more often than we think. The difference is in a big year movement-wise to the positive or to the negative, that's where you get the skew of you have more days with larger moves. And if you think about it, last year, we had 2x the historical average of big moves to the positive or to the negative. And with more trading days being in negative territory, that's where we saw losses in the S&P 500. Page 3, why was calendar year 22 so difficult from a fixed income investor standpoint? Flat out, there are no bankruptcies. There wasn't a technical recession, right? There wasn't any missed payments, right, from a bondholder standpoint. It all comes down to price. And flat out, we haven't seen this magnitude of an interest rate increase in a very, very long time. So the front end of the curve, think 1 month, 2 month, 3 month, is going to be Fed driven. Start of the year, it was difficult to be a treasurer and invest cash because you could buy a 1 month, 2 month, 3 month treasury bill and it would round up to a positive return. Those same investments today are paying somewhere between 4.1 and 4.4%. Why did we see a negative 13% return out of broad, high-quality U.S. fixed income? Look at the 10-year, for example. So a 10-year treasury you buy at the beginning of the year, paid you 1.5% for the next 10 years. You buy that same 10-year treasury today, or at the end of calendar year 22, it would pay you 3.88%. That's a 2.36, but call it 2.4% increase. So nothing changed from a credit quality standpoint, right? No payments were missed. So that negative 13% return, and frankly, if you're talking about long-term treasuries, that number was more like negative 20 to negative 30% for the year. Pure price adjustment. Think about it. If I bought that 10-year treasury on January 1 and it's paying 1.5% for the next 10 years, and I wanted to sell it to Brian, he's looking at the market and saying, well, why would I buy your 10-year that's paying 1.5% when I can go buy this 10-year that's going to pay me 3.88%? The difference is I would have to sell my 10-year treasury at 80 cents on the dollar, not 100 cents on the dollar, so that what I've purchased for it, what a buyer pays for it, it's the same level of income that they could go out and purchase for a similar security. Put it together from a diversified portfolio standpoint, kind of that traditional bellwether 60-40. On page 4, again, looking at the last 46 years. Calendar year 22 was the second worst. 2008 was the worst from a modern history standpoint. Again, recall the S&P was down 37% that year. But in 22, from a traditional diversification standpoint, stocks, bonds, you could argue cash was in positive territory. But even though you made 3 or 4% in your cash portfolio, you lost 8% from an inflationary standpoint. But definitely a difficult year for investors. Final piece I'll leave you with is what's affectionately known in the industry as the quilt, page 5. What we're looking at is calendar year returns, from 2008 to present. And the idea here is pick a color. If you start, for example, on the top left-hand corner in 2008, U.S. fixed income was number one performer in 08, second from last in 9 and 10, second from the top in 11, second from the bottom in 12. The idea is the leaders in any given calendar year might be the leaders the next year, but are very rarely the leaders in the clubhouse, 3, 4, 5 years in a row. We typically see top of the pack become bottom of the pack and bottom of the pack become top of the pack. There's a rotation of leadership. And this is why, plain and simple, we have a diversified portfolio. Of note, real estate was the number one performer last year. Investors were doing cartwheels because the real estate portfolio was up 7% because everything else had a negative sign in front of it. Going into the bound book, take just a minute. Front of the book is a cover letter and just an update from our CEO, Mike Walker. Always an opportunity just to give an update on where things sit from a firm standpoint. We're now 93 employees strong. I was looking back in this is now my 7th year with the firm. When I started, there were 65 employees, 30 of which are consultants. So individuals like Mike and myself that are out in the field, right, working with clients directly, driving revenue for the organization. We're now 93 employees with the same number of consultants. That consultant pool has changed a little bit, but there's still 30 consultants. And that's really testament to, our research team has doubled in the last 5 or 6 years. Finance, human resources, senior management, all of these investments really into the infrastructure of the organization. And what it really allows is for us that are out in the field to look at clients and say, the fees that you're paying us, the investments that you are helping us make into the organization, help us to continue to drive the success that we've had last year and this year and in the years ahead. So a tremendous amount of growth in the organization. And you can really see it in the org chart on page 2. The consulting team in the middle here, from a number of individuals, that hasn't changed, but it's all of the support around that help us drive success for clients. One other important note, Mike had mentioned this last year around this time. This is something that I was really, really pleased to be a part of, the conversation around who are the new partners in the firm. Throughout the year, the existing partners nominate individuals, and our CEO then selects, and this year, 3 individuals. Brooke Wilson, who is our head of performance reporting, recently promoted from the director of reporting to now the executive director, so she oversees the entire team. And then 2 consultants in our Florida office, John Breath, who's been with us for about 10 plus years, and Tyler Grumbles, who's been with us for over 15 years. So great to see some other individuals.
Tyler may have started when he was 10, because he looks like he's 25
Yeah.
years old.
Yep.
I was blown away when I heard 15 years.
Actually started as an intern with the organization. So he may be close to 25. So talk specific to retiree healthcare, take you to page 5. I'm happy to talk about the quarter because it was good news. Saw strong performance for retiree healthcare, up 785 for the quarter for the overall combined portfolios, about 1% ahead of the policy index. If I can sum up fourth quarter in one sentence, it was patience was rewarded. Those funds that had been most challenging throughout the year, Edgewood, Oakmark, did phenomenally well. So if you look from a manager by manager basis, Ancora, being value biased, dividend biased in their portfolio, underperformed a little bit. Hard to be upset, up 1165 for the quarter. It was the best performer from a domestic equity standpoint. Lagged their benchmark a little bit, really because of healthcare names like CVS, Medtronic, and Abbott. And then one of their biggest laggards was actually a non-benchmark position, but they have about a 3% position in Apple. Ironically, Edgewood, your growth manager, has no Apple exposure. Your value manager feels that it's an attractive purchase at this point in time. Fidelity S&P 500, no surprises, up 7.5%. It is kind of interesting when you dig a little bit deeper. No surprise, the number 1 performer for the quarter was Exxon. The worst performer was Tesla. Tesla was down 54% for the quarter. Edgewood, very, very strong quarter. Combination of what they didn't own, Apple, and a combination of what they did own, literally across the board. All 22 names contributed as we saw the market rotate away from really being macro focused to being more earnings and quality focused. Clarkston, another fabulous quarter, up 9.6% versus benchmark up 7.4. They are almost positive for the calendar year. They're down 0.12% versus their benchmark that was down 18 and change. Couple big drivers. Change Healthcare was taken out in early October. That was a big boost to returns. A number of their asset managers, like Affiliated Managers Group and Franklin Resources, that's Franklin Templeton, all helped. No surprise, the biggest laggard was and continues to be Altice, the cable company out on the East Coast. Fidelity Extended Market, no surprises, right in line. It's amazing to see the difference between that small mid-cap portfolio or that small mid-cap index and some of the others, because it owns some larger names like Blackstone that don't qualify for the S&P 500. Largest negative tractors were names like CrowdStrike, Rivian. Seems to be a theme here in terms of electric autos. Although I'll tell you the Tesla issue and the Rivian issue are 2 very, very different results. Lululemon and Horizon Therapeutics. Oakmark, a laggard coming into the quarter. Absolute blowout quarter, up 23% versus benchmark up 16, so more than 7% ahead. Thank you, US dollar, kind of retracing and declining in value versus a lot of major currencies. They were helped, and it's, again, this is the same story of what hurt previously has now helped, is names like Prosus, Continental AG, Daimler Truck, Mercedes, and those were names coming into the quarter that had been causing some decline. Fidelity Index Fund, no surprises. JP Morgan, nice outperformance, almost 1.4% ahead. Excuse me, it's the big names. Samsung, Tencent, Taiwan Semiconductor. Finally, page 6. From a fixed income standpoint, no surprises here. You know, as things kind of cooled from an inflationary standpoint, we actually saw fixed income rally. So we actually saw rates decline. Saw an article last week, and this was surprising to me, right? The mortgage industry is pretty much seized up. You know, the thought of doing a 30-year fix north of 7% is just crazy, considering it was less than 3%. You know, less than a year ago, it was less than 3%. There was a 25% increase in mortgage applications because the 30-year went from north of 7 to just over 6%. So this idea of 6% now seems like an attractive interest rate or an attractive entry point. What I didn't see in the article, and I want to dig a little bit further on, is how many of those were refis from purchases that were done earlier in the year, right? I bought it 3 months ago or 6 months ago and was paying north of 7. Now 6% is definitely attractive, not necessarily from a new purchase standpoint, but just in terms of being able to lock in a lower rate. So you saw that rally a little bit. You know, Baird's up 1.6%. Still obviously in negative territory for the year. And then Brandywine, more emerging market exposure, you know, less US dollar exposure as we saw rates decline on a global basis, as well as the US dollar fall in value. Big rally for them, up north of 7% for the quarter. Still well into negative territory for the year, again, because of, you know, significant increase in interest rates on a global basis, but held in and did a good job on a relative basis. So all in all, you know, for the quarter, nice start. On a calendar year basis, down about 15%. Numbers still coming in from a universe standpoint as systems continue to populate data, but that would put you about in the middle of the pack. You know, we've seen a lot of the median plan down around 14.5 or 15% for the year. We've seen a couple down more than 20. Those are obviously, you know, a lot more equity exposure, a lot more risk on. They don't have as much in fixed income, or they have a lot more invested from a passive standpoint. But you had managers like Clarkston that held in really well, and Ancora that have done well in terms of just protecting capital in a difficult market environment. That's the extent of prepared comments. Happy to take any questions.
So Brian, when we had presentations from both Clarkston and Edgewood, and after both presentations, both have done exceedingly well after we spoke with them. Is there anyone else we should be talking to?
Can we just bring in everybody? We have a few strategies with a different client that we could maybe bring before just for that conversation.
Okay. It is interesting. I mean, you know, they actually...
There is a direct correlation there.
Well, in the case of Edgewood, you think about growth stocks in general, right? For the first 9 months, it really was just, everything was macro-driven. Rates go sky high, and those long-dated, long-duration assets get repriced. Whether you're profitable or not, it didn't matter. They all get wiped out. And then when you get to the fourth quarter and people start paying attention to fundamentals and earnings, you saw a complete bifurcation. Companies that missed, like today Exxon was one of the best performers, and you said Ancora, right?
Yep.
Earnings came out, record profits, but they thought they missed on a couple metrics, and right now it's down 5% in the free market. It's really driven by fundamentals and earnings, right? What's the guidance and how did you actually perform this quarter?
I have a question, a couple questions. The inception date, that's when we bought the fund, right?
Correct. Yep, for the individual managers, that's your start date.
Okay.
That's your actual performance. It's not pulled from a composite or a mutual fund.
Sure, understood. Okay, that's why, because I mean, I figured that these weren't when these funds were started. Right, okay. And then on the financial reconciliation, I just want to understand this, that we essentially have one pool that's allocated across these funds, and then you guys just have like a sub-ledger or something that says how much is building fund, how much is...
These are all segregated.
So they are segregated?
Yep.
Each
We
one is...
just,
So we have different... So is there something that shows what each fund holds?
Yeah, so if you go, for example, to page 9. So page 9 would be building. Top right-hand corner of page 9, a $2.2 million balance, and then all the underlying funds. All of the underlying...
It doesn't say that on here, it just says total... Oh, there it is, building plan, okay.
Yep.
Yeah, the page above.
Okay, page 8 is building. So this is how much we own of each of these in that fund.
Correct. We roll it all up and aggregate it from a reporting standpoint just to talk about the retiree healthcare pool in total.
Okay.
But, public safety, so retirees, public safety, water and sewer, building, general.
Right, okay. So
5
then-
pools. All the underlying managers are the same. And we tried to keep the allocations, like the percentage allocations identical. And it's, if you take it to, 1 decimal point it is. If you take it to 2 decimal points,
Yeah.
Right?
Yeah.
So that's where you will see performance differentials from time to time if you have a really big move to the positive or negative. If it's 0.10% versus 0.15, you're going to see a difference.
Sure.
And then cash flow. Some of these have, as they have contributions coming in, the timing of that cash flow is going to impact performance just on the margin.
Okay, I see now. So there's cable, public safety, okay.
Would it help to have just a summary of the market values
It might,
earlier?
yeah, so public safety's got 6.7 million.
While Michael's looking at that,
Yeah.
I just want to make a comment. Brian, this morning, when we go through the various areas, if you would touch on the statement of investment policy, what I'd like to do is just kind of look at those for each, and then at the end, part of our agenda for the defined benefit for the investment study session will be then to go through each, review the policy, and just have discussion to see if there's any thoughts, if you have any suggestions as to changing it. Otherwise, we can just kind of review it.
Sure.
Thank you. And actually, you may want to just start with this one just for us while we're here on page 20.
Yes, if you take a look at page 20. So for every asset class, we have a target. For example, for domestic large cap, that target's 24%. So if you're looking at this page, the green triangle is the current allocation. The black vertical line is the target allocation, and then the gray shaded area represents the allowable range. So we have a target for each asset class, we have a minimum, and we have a maximum. And the idea being is, when we look at the overall risk return parameters, the long-term target return, sets the targeted asset mix. But we know, right, markets are going to move. We're going to be, right, if we were at 25% today and, markets are up 10%, that 25% just became more than 25% of the portfolio, right? So it's recognition that we have a long-term target, but there's an allowable range above and beyond that just to make sure that we continue to be in compliance. Some have a larger range, like fixed income. Some have a much smaller range, like cash, right, with a target of 0 and a maximum of 5%. So all of these are laid out and are captured in the investment policy statement, as well as roles and responsibilities. We've taken a look. It's a document that's reviewed on a periodic basis from a best practice standpoint. And I say best practice, this is something to really keep, the auditors in good spirits, is to review it on an annual basis. Many times that review is, we took a look at it, we're comfortable with it, and we have no recommended changes. And that's the case today. You know, we're comfortable with the language. The beauty of your investment policy statement is its simplicity. There are some that are 15, 16 pages long. Yours is 3, and that is more than sufficient to capture everything that needs to be captured.
Any other comments or questions for Brian?
None.
Okay, thank you. The next quarterly meeting, in coordination with the FSC, would be April 26th at 7:30 a.m. Is there any new business? Hearing none, I'll look for a motion to adjourn.
So moved.
I'll second.
Second by Trustee Shostak, motion by Treasurer Keeps. Thank you.